A stock that is buzzing in trade today is L&T Finance after reporting a strong set of first quarter earnings. Asset quality and loan book improved while the NIMs moderated marginally. Sudipta Roy, who's the MD and CEO of the company, joins us. Thanks a lot, sir, for joining in, and congratulations. It was a decent set of performance that came by. You know, if I was to ask you at the end of the first quarter, and as you look at the next 3 quarters, what are you targeting when it comes to loan growth and your NIMs? Because your net interest margin saw a bit of moderation. How do you view this going forward? And loan growth, if you could give us a sense, what would lead that growth?
Thank you. Thanks for the opportunity. To take the first question on loan growth, I think as part of our Lakshya 2031 guidelines, we have guided for a 20% CAGR on loan growth. However, one of the things which is very important is that if you find risk-calibrated sort of scope available in the market to grow our portfolios, we'll probably grow at much faster pace, which has been the case this quarter. As we are sort of navigating through the sort of a possible weak monsoon as well as the ups and downs of the West Asia crisis, it's very premature to, sort of look forward and sort of hazard a guess on what should be the sort of the ideal loan growth during this period. However, I do believe that that 20% number is something that we are pretty confident of achieving. Now, obviously, if things settle down, if we have that 90% long period average monsoon predicted, and in the West Asia crisis settles in the sort of, it has been going up and down, right? And if it settles in the next couple of sort of weeks, finally, then, we are looking forward to a sort of a relatively strong festive season as well as a good fourth quarter thereafter. So hopefully, the loan growth should be upwards of 20%. But however, as of now, we will stick to our guidance of 20% plus in line with our Lakshya 2031 statement. In terms of NIMs and fees, if you see, our headline yields have remained relatively stable, but primarily because of the weighted average cost of borrowing has gone up by about 3 basis points, and we have a much larger balance sheet. That has given a 25 basis points impact on our NIMs this quarter. However, if you look at the correspondingly, our fees have been also higher because we maintained a little larger amount of liquidity this quarter, primarily because of the West Asia crisis. We wanted to have a little bit of liquid assets available. That has risen to a higher level of liquidity income. We have had good sort of realizations from our personal loans and SME collections in terms of fees. Our insurance yields have gone up, so our fees have actually jumped this quarter. So overall, our NIMs and fees remain stable.
Got that. Sudipta, hi, good morning. So just on the personal loan portfolio, right, that's growing at a very, very fast pace, some 80% growth year on year, 15-20% on a quarter-on-quarter basis. What's giving you the comfort to grow, it's a conscious decision to grow at that rate, right? So just talk to us a little bit about that.
Yeah, so, personal loans, largely our distribution philosophy has been, to tie up with what we call the large digital partners, the likes of Credit, Google Pay, Phone Pay, Amazon, and sort of push forward our origination on that. Now, these are the platforms where you find large pools of salaried customers. And these are the platforms where, you are able to build joint scorecards and sort of jointly agree to risk thresholds and sort of cherry pick the customers that meet your risk profile. And because the opportunity of the customers to see the loan offers on these platforms are probably far higher than other platforms. Once this platform stabilizes, they actually see near vertical growth if your digital journeys are sort of frictionless. What we have done over the last, sort of 12 to 18 months was that fine-tune our digital journeys and work very closely with these digital partners. And actually, these are the digital partners which are actually driving our growth. Our cross-sell business, especially to our two-wheeler customers, and we are a pretty large originator of two-wheelers, and we have been originating a large amount of prime two-wheeler loans over the last 12 to 18 months as well. That the cross-sell business also has, the personal loans cross-sell to the two-wheeler business has also increased. So overall, between the sort of increase of disbursement through the digital partners as well as increase of cross-sell to our two-wheeler customers, our personal loans business has actually maintained a strong growth. However, the risk-calibrated sort of outlook remains, and actually our credit performance on the two-wheeler business, on the personal loans business continue to improve with every passing quarter.
And this is coming through what, 2-3 platforms, this growth?
Primarily Cred, PhonePe, Google Pay, and Amazon. These are the large partners.
And
However,
this will,
there are a couple of other partners.
and the rates of growth will continue to be turbocharged here, or you will moderate it. I mean, depending on what happens.
I'll sort of say that probably as the balance sheet size grows a little larger, it will probably moderate towards the end of the year. However, for the next couple of quarters, the growth rates are going to remain strong.
All right. Hi, Mr. Roy. Good morning and good to see you, Ben. Well, tell us a little bit about the ECL. Is there a possibility of there could be a rise out there? And what's giving you confidence that, by the end of this year, credit cost comes down, I think, to around 2% odd is what you're guiding for by the end of this fiscal year?
Thanks, Nigel. I think when you talk about our ECL models, we actually calibrate our ECL models once a year, which is in Q4 of the financial year. And this year, we have been prudent on our ECL modeling. And the fact is that we are now providing more also on stage one. As our balance sheet is growing larger, as part of our ECL model, we are providing more on stage one and stage two, and also keeping stage three adequately provided. So obviously, if you see our PCRs sequentially have risen by about 2 percentage points from 67 to 69%. And as our balance sheet grows larger, we'll be prudent in our ECL modeling. However, if you look at our credit cost has been at 2.54% this quarter, downward trajectory of about 10 basis points, effects of all our credit work that we've been doing, especially on Cyclops, which is live on our 4 business lines and going to be live in our microfinance as well as mortgage business line this year, has been showing its results. This will continue coming down by about 10 to 15 basis points every quarter till we reach the trajectory of 2 to 2.2% as committed by Q1FY27 this year. And as we have committed in our Lakshya goals, we do not stop at 2 to 2.2%. We actually want to drive it further downwards from 2% as part of our Lakshya goals. So over the next financial year, you will see this pairing downwards below from 2%. So obviously, the downward pairing of credit costs will continue, and our credit frameworks that we have built, our AI-enabled credit engines that we have built, are delivering excellent results. The results are enshrined in slide 14 of our analyst deck, and we urge our investors to have a look. And I'm very, very confident that this trajectory will continue downwards.
I'm looking at that deck itself, Mr. Roy, the Lakshya 2031 goal that you have. It reads more like an American AI agent as against an Indian finance player, the kind of deep tech and operating system that you've spoken about. I just wanted to understand from a business standpoint, if you could, over the next few years, give us a sense on how much it increases your business prospects by, and secondly, how much it reduces your costs by. If you could quantify those data points for us, and what is the kind of PPOP or cost to income ratio that we should target going forward?
So thank you for that question. The fact is that we have been investing very heavily in this new emerging technology, and we have almost a technology team of about 1,000 plus, engineers and data scientists now between our technology centers in Bangalore and Mumbai. In terms of business, I'll give you an example of our two-wheeler business growth. When we implemented Cyclops in our two-wheeler business, and that's been 24 months in operation, actually, it is an engine that actually sort of sharpens credit growth, sharpens credit. And so when we implemented for the first time, we actually saw our market shares fall. Our actually market share fell from about 7% to 5.5%. But however, as the portfolio continued to clean and as our systems, and as our sales teams, sort of got used to operating within that sort of environment, actually our market share started going up. So wherever we were doing about 650 to 700 crores of disbursements on two-wheeler business 1 year back, we're currently doing about 1,000 crores of disbursement on a monthly basis. And our market shares have gone up by, depending upon the market, has gone up by between 1.5% to 2.5%. Right? So the fact is that this we expect to happen everywhere. First, the system will go through a little bit of norming, and then as the system stabilizes, it will give our sales teams as well as our digital channels far, far more sort of latitude to increase our market share and take those customers which others are afraid to sort of underwrite, because we are underwriting the customer in a far more deeper holistic sense, and we are very confident about their outcomes. Now, in terms of efficiencies also, in our collections business, it is showing efficiencies. For example, wherever a human call in terms of self-cure, in terms of curing a pre-delinquency would take anywhere between 280 to 300 rupees. Currently, we are doing about 10%, within 10 rupees, we are curing those sort of delinquent customers. So obviously, in the last 3 to 4 months, we have only saved about 70 crores in our sort of pre-delinquency management exercises, especially in our urban business, by using our AI bot calls. We have also sort of deployed a lot of co-pilots. I would not like to go into granular details here on the call, but I would urge our investors to look at it in an investor deck. Overall, I do believe that, over a period of 3 to 4 years, all our AI initiatives will add somewhere between, 30 to 40 basis points in terms of, OPEX improvement overall. And obviously, and probably a market share gain. Market share gain is a little difficult to quantify at that particular point in time, and we will have to see how that pans out. But overall, what we can say is that the implementation of AI, especially on a cost-calibrated basis, we are very focused on cost of AI as well, will be net positive for the company, and we remain steadfast on this approach.
Okay, all right. Sudipta, thank you very much for joining us. Good speaking with you. Stock's done well. I mean, I think coming about 23, 24% coming into the first quarter results, another 3% this morning. Numbers all doing great. Expensive. It's a question mark. 2.5 times FY28 book. Of course, this is forward estimates, but won't change much if you look at a range of estimates for the next 2 years or so. 331, phenomenally. Stock's done very, very well. Well, Jio Black